What is going on, YouTube? I'm Mike with Penner Investments, and today I'm going to discuss trading the wheel strategy safely. Be sure to hit the like button, share this video so others may learn, and subscribe to my channel so you do not miss out on future content. All right, let's jump in. If you regularly watch my channel, you know I'm a big fan of the options wheel strategy. This strategy brings in consistent income and is easy to do and has helped me beat the market by a large margin. I'm not trying to brag here, but my returns are just over 100% for the past year. I just want to show you what is possible. As a refresher, the wheel strategy is selling cash secured puts on stocks or ETFs, and I like to use 30-day options on the put side. Once assigned, I sell 45-day covered calls and continue to repeat this process. I just rinse and repeat. To add a level of safety to this strategy, I've recently started trading the QQQ and the SPY on the wheel strategy. These are two ETFs. This eliminates single stock risk. With single stocks, you have to worry about earnings. If you trade an option over the earnings report date, you also have to worry about the company coming out with bad news that could cause the stock to plummet. This is avoided when you're using an ETF. The QQQ has 100 companies in it, and the S&P 500 has 500 companies in it, so they're pretty diversified. So you don't really have a single stock risk there. Still, with an ETF, the only risk now with this strategy is for the market having a correction or staying in a declining market. Let me explain where the problem comes in here. In a declining market, you get assigned on all the puts you sold. If the market continues lower, it starts to get harder and harder to sell covered calls above your cost basis, or essentially the price that you were assigned the stock. And anyway, this is one of my rules for doing the wheel strategy is I do not sell a covered call below my basis in the stock. The reason why is if it gets called away, I'm guaranteeing myself a loss. So how can this be avoided or minimized? What I like to do is stagger my puts that I sell in different weeks. I do not go all in 1 week. For example, if I had $250,000 to use in the strategy, I would not invest this all in the same week. I like to spread this out over multiple weeks or even out over a month. I sell a few puts in week 1, then I wait until the next pullback the following week or a couple of weeks later and sell some more puts there. This helps to minimize how many option contracts that I sell in 1 week, and it also helps me avoid being all in when the market has a big pullback or some kind of bad news. Kind of like back in 2020 when COVID came out back in March and the market dropped like a rock. It dropped down like 20% all in 1 month. I learned this the hard way back then, and I just want to help you from having the same problem because the market's always going to have something that causes it to have a correction or a pullback. Once all your capital gets exhausted, you're just sitting on the sidelines waiting for the market to recover so you can resume selling covered calls and start repeating the strategy. This is why it's very important to not go all in and keep some capital available for the future to keep income coming in. It is always very nice to have some cash to take advantage of the market pullbacks, as that is when stocks are on sale and option premiums are at their highest. If you've got some cash set aside, then you can resume selling puts when the market's at a low and also take advantage of buying some very low price stock. As always, if there's ever anything you'd like me to discuss further, drop a comment in the box below. Thanks for watching and good luck trading.